Hi, everyone. It is so good to be back after the break we had in August. I hope everyone had a chance to reset. I'm going to be bringing Julian up in just a minute, but I wanted to give you a quick update first. While we were on hiatus the last few weeks, we were very busy behind the scenes. You may notice the new look and the new name. We're calling this adventure the Market House. From the start, when we launched last year, we didn't want just another podium or shouting match or clickbait. We really wanted to create what we were thinking in our minds as a bar vibe, a conversation that all of you can actually join. We'd like you to think of the Market House as your favorite local spot where there's valuable conversation on tap. The company's good, and you may actually walk away with some clearer ideas than when you came in. Some things are going to stay the same. Talking Markets continues to be the heart, Monday, Wednesdays, and Fridays, live at 4 p.m. Eastern. The next day, write-ups on Substack if you missed something. That's all going to stay the same, and that will remain free. But very excitingly, we're going to be building out more shows, more conversations, and hopefully be giving you more reasons to pull up a chair. For some of the new shows, they will be for our paid members, and I'm going to share more about that next week, but we wanted to let you know what our plan was from the start. So we're super excited about this. Our overall goal is pretty simple: clarity over noise, civility over shouting, and maybe a well-timed cocktail recommendation along the way or some fun like that. And we hope you'll join in and brainstorm with us on all of that. We are, as a lot of you know, a tiny team. There are just 3 of us bootstrapping this for the last year. And we don't have any corporate backers, no agenda, just a belief that investors deserve a better conversation than they've been getting, than we've all been getting. So if you value that, please subscribe, share, spread the word. We want you to feel like this is your house too. We are on Substack at themarkethouse.substack.com. Subscribe there because that's where we're going to be dropping a lot of information. You can just search up my name as well, or sign up for our email list, which is in the link on YouTube. So super excited to be back. Okay, let's jump in. I'm talking markets today with Julian Brigden, co-founder of MI2 Partners and creator of the MacroCapture. Hey there, Julian.
Hello, Maggie. How are you?
I'm doing well, thanks. Doing great, and kind of excited to kick off the month of September, although we may regret saying that. Hey to everybody who's joining us live on YouTube and Substack. So good to see some familiar names. We've missed you guys. As always, you can drop your questions in and we'll get to as many as we can. So not too bad today. The S&P and NASDAQ managed to advance thanks to gains mostly in Google and Apple, with a news crossing last night about antitrust moves. Bond yields bounced around a little today. The 30-year moving above 5% briefly before backing off. Gold was up, crypto up, the dollar down. Julian, I mentioned maybe regretting saying I'm excited to be back because September can be a pretty volatile month. How's it feel to you? Are we in for a rough ride here?
I don't know, Maggie. I mean, look, when you look at a lot of the sort of systematic sort of stuff, it definitely looks quite stretched. So you look at CTA positioning, you look at sort of vol sellers, I'm talking really about the equity market here. Then that is a market which seems to have gone all in through the summer. And to your point, and retail's been buying. I looked at some Citadel data that they had the other day, 17 out of the last 18 weeks. So people, and I look at some of the stuff that I look at, people are definitely long. Right? They're definitely long risk. They're definitely long US stocks again. We're getting, more of this, maybe US exceptionalism isn't over yet, all that sort of stuff. I think it's hogwash, really. I can describe it much more aggressively than that, right? This, I really get extraordinarily frustrated, even with Bloomberg. And now, look, I'm an old man, so I'm allowed to shout at the TV. And I find myself shouting at the TV because even on Bloomberg, which is really aimed at professionals, they talk about and use this on the terminal and go use that on even in the morning shows. All they talk about is the S&P hitting a new high, the S&P hitting a new high, the S&P. In euro terms, it's down 6% on 6 to 7% on the year, right? So we are incredibly good in this country at blowing smoke up our own asses. No offense. right? And that's what I think. And meanwhile, there's a whole story developing out there, which people are not focused on.
What is the story that people are not focused on?
So I think the focus is that we are in a capital rotation event, that I think we have seen a long period of US exceptions, which I think is a reflexive cycle. I think that has had a great run. You made a lot of money out of it. And now the dynamics that fostered that are beginning to change. And in particular, I think the dollar story is a big driver of that. It generally is a big driver because it is the reserve currency, because it tends to attract money into US equity markets from foreigners when they, can double dip on a rising US dollar and outperforming US equities. And I think after 15 years, we've got so used to that we've forgotten that there are times when, as the dollar declines, which is what the administration vehemently wants and seems to be quite aggressively pursuing policies to achieve that, which isn't wrong, right? Because we really do need to rebalance some things, right? That just has massive economic consequences. And those are not the time that you are limit long tech stocks, right?
Yeah.
Those tend to be the worst performers on a relative basis. So I just look at stuff and I just think there's lots of opportunities away from that. And I think the financial media in this country, which is really designed around cheerleading you to constantly keep buying US stocks because that's how they make their advertising revenue. So they get the people on the shows who are like, yeah, US big cap, and oh, we like, this, and oh, if it's not that, we definitely want small cap because they're going to cut rates. And you're like, okay, but if they cut rates, the dollar falls, and maybe what you really should be buying is mining, metals, emerging markets, gold, silver, right? And that's what I've had my money in for the last 6 months. And trust me, it's been quite good fun.
So, Julian, you just described perfectly why we launched the Market House. So thank you for that. That was not a setup, but you're right. There is a bias for bullish equity for all the reasons that you just described. And there's also a very, very US centric view always of what's happening. And I think that a lot of people listening will probably agree that we are in an environment now, or in a period in the markets where it's no longer prudent to do that. There just too much changing on a macro landscape, and politically and geopolitically, and at the intersection of that, where it's not prudent to do that.
Right.
So let me ask you a question. You're just to put a exclamation point on that, you're saying the story to pay attention to is in currencies. Forget about looking at the record highs in the US stock market and only through the lens of the US dollar. You need to look at it on a currency adjusted basis.
Yeah, it's kind of a real, whatever metric you want to put in there, Maggie, for to cover up what frequently happens, which is money illusion, right? I mean, if you destroy the value of the denominator, so like in Weimar 1930s Germany, the Reichsmark, as it was at the time, was collapsing in value, right? Those are the pictures of people in wheelbarrows going to buy their loaf of bread, stacked up with notes. Well, the equity market was rising commensurate with the collapse of the currency, because at the end of the day, if you had a share that was a claim on, Krupp Steel, right? Krupp Steel was still going to make steel, right? Why should it be much cheaper than it was before, just because the denominator, the Reichsmark, was falling in value? So when you look at the S&P, you would expect it to rise as the value of the dollar falls, because you still have a claim on Nvidia or Tesla or Apple or whatever, right? And those are still viable companies making products that people want. So I think it's quite important for Americans, and as I said, it's a very domestically centric world where the recency bias, which isn't even that more recent, right? 15 years of US equity outperformance creates a bloody enormous, machine to just keep generating this sort of inertia to just keep going. but the fundamentals that underpin that are beginning to change. And I think that's going to create enormous opportunities, right? So I was looking at, one of my favorite, to use, if I may, chart porn charts that I have, right, is I like to look at XLK, which is the tech ETF, divided by XME. And if you do that on a log chart, you will see that we just blew through a downtrend. So in other words, XLK was outperforming the mining metals. We just blew through a down trend that basically has been going since 2009, right? And it's quite a well-defined trend, and we've just blown through. And you forget that this is a logged chart, right? So when you look at the side and you're like, well, how far could this thing go? And the answer is, this could be like, if we go back to the highs of where we were in 2008, then this thing is basically a 12 bagger. And that's a ratio chart, because right here, right now.
Now, what are you talking about, golds or miners?
No, so this is the mining metal ETF.
Okay.
Right? XME. And versus XLK. So this thing, the ratio at the moment is 0.31. At the highs of 2008, it was 4. It was 4, Maggie. And now it's 0.31, right? So I'm not saying that we go there tomorrow, right? But I'm just saying that, the cycle, right? And even in 2011, when the dollar based, it was 3, right? So these cycles are really important. And this, from a macro guy, this is about as enticing a cycle as we get, because I think the opportunities to make money are inordinate.
So this idea that it's the end of U.S. exceptionalism, the dollar decline is happening, the administration wants it that way, it's the necessary rebalance. Were all those arguments made in April? And we saw the beginning of those moves, pretty rapid, pretty big moves, and institutions bought into that, and retail didn't. And retail made a boatload of money going in at the lows. Did that give you pause at all, or did you just see that as a kind of blow off top, one last sort of sentiment surge before this?
No, so I think, look, as I said, we've had 15 years of buying the dip and the recency bias, right? You are certainly not going to change that overnight, but you would still have been better off, at the beginning. I mean, everything's sort of bounced since April, but I can tell you, I've made way more money in XME than you've made in, the S&P, right? And as I said, in euro terms, this is still down. I mean, I think people misunderstand what the administration is trying to do, right? They are trying to reset the global economy, the global trade anyway, and reset the US economy so that we are not so dependent on imports. So we are, whether we'll ever get to a balanced budget, that would be a nice thing, but conceptually, right? So we have a better, more balanced budget, but that comes at a price, right? We're going to have to raise money via tariffs, which is essentially a VAT on Americans. It's just a handy way of saying that foreigners are going to pay for it when we kind of know that they're really not. So they just raise taxes on us all, right? And that's fine because we don't pay enough taxes and we need to balance the budget. Then there's the current account deficit. Well, the current account deficit is, for the last couple of quarters, has been running at 6% of GDP. That's insane, Maggie. That's insane. That's like the 08 highs, right? Before that bubble burst. And one would think over time that as that current account deficit shrinks, because you would hope that these tariffs would cause Americans to import less, right? I'm not saying it's going to happen overnight, but it should. And that will actually encourage it. Mechanically means less money flows into the US from the rest of the world. Now, that money goes into one of three things, roughly: the bond market, the stock market, foreign direct investment, building a factory, right? So the president wants more going into FDI, right? You've got to build a factory over here. We want you to build a factory over here. Okay, fine. And I think that's totally logical, but that just mechanically leaves less to go into of a shrinking pot into bonds or into stocks. So going forward, Maggie, I think unless Americans are willing to massively increase their own savings rates, right, and they offset the foreign buying of assets, right, which would have consequences, right? If suddenly Americans started to save 6% of GDP, right, in savings, I don't think consumption would be doing very well, right? We might have a bit of a recession, right? But if that isn't going to happen, which I don't think it is, then you should expect less foreign money to flow into US assets. US assets will generally underperform. And I'm not suggesting they collapse, right? But that's how you get to situations where you look around and you go, oh, in euro terms, I'm down on the year still. I'm not up on the year at all in the S&P, right? I'm down on the year. And I think 5 years from now, I think, and this goes to what Scott said, if you remember, Scott Percent said, last year, more Americans went to food banks than ever in history. At the same time, the more Americans went to Europe, right? We have to rebalance this equation, which basically means higher wages through reindustrialization here in the US and less wealth effect, right? So I think in 5 years' time, if we had an S&P that was up, I don't know, 15, 20% in dollar terms, right? But was down 30 to 40% in euro terms or yen terms or gold terms, I think they would feel that that was the right adjustment because the brunt of the adjustment would have been felt by foreigners in absolute terms. Americans would feel it in real terms because you go, oh, that trip we were planning to the Amalfi Coast a couple of years ago, bloody hell, how much is it costing now, right? I think that's exactly where we're kind of going, right? I think, and I'm not saying it's wrong. I think in many, many respects, it's absolutely right to try and attempt it because we are on an utterly out of control trajectory. And you can see that in bond markets everywhere, right? The governments are just spending like it's gone out of fashion. I just think it has inordinate consequences.
Yeah, talk to me about what we're seeing in bond markets, because I know we've had points dating back to April where we've had, yields spiking. We saw it even today, as I mentioned, but then they went back down on data.
Right.
So but European yields were on the move. What did you make of that?
So look, all of these countries are spending too much money, right? When you look at the long-term trajectories really no one mentioned this morning, they were like, oh, well, gilts, its problem was gilts. And actually what really blew out last night were 30-year JGBs again, right? They just blew straight through a big level again last night, right? So we have pressure coming from, and it doesn't really matter, whatever morning you want to say, right? It's gilts. Oh, no, it's bunds. Oh, no, it's oats. Oh, no, which are French bonds. Oh, no, it's treasuries, right? And what people forget is this great bond word, fungibility. All bonds, if you believe in the credit rating of the government, that they're all roughly the same because they can always pay you in their own printed currency, right, are fungible. I can create a treasury out of a gilt with an FX swap, right? And that's what it is. So they all should trade roughly pari passu, sort of in line, right? They should all roughly trade in line. And so when I look at them all, they just all look at a trajectory that is up and to the right. And I think there are some big structural forces that are driving that, Maggie. A lot to do with demographics and a shrinking pool of global savings as people age and start to consume the savings or spend the savings that they've saved in their working years. I think that all of these governments are trying to blow out their bloody budgets at a time when the amount of cash that's available to buy the debt that they're doing is shrinking. And I think there's not much they can do to stop. Well, there are things they can do, but that's another question. But the natural inclination of bond yields everywhere is going to be up and to the right. And I don't think there's much we can do about that.
Does that not end in a sovereign bond crisis? It sounds like when you see.
Yeah, you could come in and you could say we're going to do yield curve control. we're going to do more QE. And then you're like, okay, well, then your currency gets tarred and feathered, right? So that's why I think you're starting to see people play through these end games. And these end games you would hope would be 5 years away, right? But they might be 2 years away, right? I mean, I've got some chartists that I follow who look at silver, and it's one of my favorite trades. It's been a great trade, in the last few weeks. But I've been long for a long time, and the miners and gold and so on and so forth, who look at silver and they go, okay, well, this run gets us to like 50, and then we have this big correction down to like 30. But that's probably part of a correction in risk assets globally, so basically stocks. And then we go from 30 to either 200 or 300.
That's a huge move.
Right? Now, if you're long silver, you're like, oh, that's fantastic. And I keep saying to people, okay, but think about the world that has to exist to get silver to 200 to 300. You may not like it,
No.
right? What's going on with the dollar at that point, right? How much money are we printing maybe to hold the global bond market yields down, right? How independent is the Fed, right? All of these things, I think, create opportunity, but that's why I say, I mean, this is an amazing macro environment. I'm not saying it's not challenging, but it's an amazing macro environment.
So Ian asking, which of gold or silver will outperform to close out the year?
So typically, silver is kind of more of a good time metal, in the sense that the ideal circumstances for silver are a strong underlying risk environment, so stocks up, with a weak dollar. Okay. My gut is that, I mean, I don't know whether I chase silver outperformance in September, given what we talked about at the beginning of the show, that it could be a wobbly period. But the minute that anyone proposes anything like yield curve control, or we start to see the dollar start to fade because we really are moving to monetary policy by presidential edict, right? The Captain Picard, make it so, right? Right? The minute we see something like that, silver should really explode.
Trevor has a great question, and we could probably sub out even European, but great to be back with you, Trevor, by the way. Julian, I'm a UK-based investor. Aside from cash and gold, where else is safe until we are through the correction? I would say, do you think, I mean, these sound like long-term trends you're talking about here in terms of allocation. So you can,
these are
very weigh in on the correction, even if that is,
Yeah, they're very long-term trends. I think, we are in absolutely nascent, you go look at these long-term rotation trades. We are in the foothills of these things on a relative basis. So I think you have to be circumspect about when you get in. I think you have to be circumspect about when you value stuff. But I can tell you, like, personally, I have no money in US stocks. I have no money in US stocks in my portfolio. I have money in overseas stocks. I have money in emerging markets. I have money in emerging market debt. I'd much rather own Brazil at 15% than the US at 4.5%. I get paid for the risk, certainly than the UK, right, at 5%. Right, I just see no reason for that. I own a lot of precious metals. I'm trying to sort of like maneuver into broader commodities yet, but I'm not sure if we're right yet at that time, Maggie. Because that raises the question: is how does this rotation happen out of existing holdings into the new capital rotation event? And typically, you end up. I say that there's only two ways that ratios correct, right? There's the nice way, so the cheap asset rises in value as the expensive asset treads water, right? And the ratio corrects from below, right? Or there's the nasty way where the expensive asset craps out and the ratio corrects. The problem in the nasty way is even the cheap asset rarely rallies, right? So if you look at 2000 into 2002-3, silver outperformed the NASDAQ, right? Or the S&P, right? Well, sure, because the NASDAQ got annihilated, but silver didn't go up, it went down. It went down less, right? So that's some of the complicated when you look at some of these more economically sensitive assets, so like copper, like platinum, palladium, even some of the agricultural products, right?
Yeah. So it's so interesting. I mean, it sounds like you're really sort of moving. You think we're in a hard asset environment now. It sounds like
Yeah, I mean, I think so. I think, look, don't get me wrong. I think you can still have soft assets go up. It's, look, I would not be surprised to see a dip in US stocks, but my base case is that US stocks just, and potentially quite a sharp one, but my base case is US stocks just underperform, Maggie, right? That 5 years from now, as I said, as a US investor who's stuck with tech, you'll look and you'll realize that you haven't made nearly as much money, that essentially you've been the frog in boiling water, right? But that's what I kind of think. I think we just got this big, slow, lumbering capital, and you can't wait too long. So like I said, when you look at this XME, XLK, so mining and metals against tech at multi-decades extremes in terms of pricing, from 2002 to 2008, when the dollar was last week, and it wasn't the collapse of the dollar. I keep saying to people, I was in New York at the time. I didn't feel like it was something out of Mad Max Thunderdome, right? I was running around having a great time in Manhattan. It's just the dollar was falling in value. And as a result, US assets underperformed. And, when you look at how those assets relatively performed, you were much better off being in overseas stocks. XME was the mining and metals was the best performing sector to be in, as was oil. I'm not sure oil this time because of structural things, but you get the point, right? It was the worst place to be was where everyone was in, 2000, 2002. And so that's kind of my thought process. This is in the infancy. You might look at some of these things and go, wow, they've rallied a lot, but understand that the total market cap of XME, the mining metal ETF, is 3% of the total market cap of the tech ETF. 3%, Maggie. So it doesn't take much of a capital allocation out of one and into the other. That's why we were telling our clients back in sort of April, don't wait long to buy some of this stuff, because you'll blink and it'll have gone up 100%, and then it'll go up another 100% and another, right?
Well, and you bring up a really important
numbers, Maggie.
You bring up a really important point, because I think there are people who think, well, I haven't done it yet and I missed it. Like it's like that resistance to buy it at a record high. It feels like, well, I'll just wait. Like, why would I buy it when the move's already happened? You're saying this is the beginning of a much bigger.
I mean, I think structurally, right? If you've got a 5-year view, I think that's structurally. And don't get me wrong. If you buy it, if as I said, I think silver could go to like $50. We're, most of the way there, right, already. And then if it comes down to 20 and you just piled in at, or 30 and you piled in at, 50 and it drops, you'll feel pretty pissed off, right? So I think, you've got to have a structural view. If you're trading it, that's one thing. If you're investing, it's the other. But I truly think, if you believe this administration, and I do, at no Scott percent personally, that they have an objective and a plan, and it's about rebalancing, then you just have to really go down the line and think of the consequences, and they're quite profound.
So,
from an investment perspective.
They certainly are, as you describe them. Question from J&J: does Julian have a view on growth versus value during the rotation? And are there certain parts of the world he likes? You mentioned emerging markets, and I know you mentioned Brazil.
Yeah, I mean, growth value is really a sort of synonymous with basically US versus the rest of the world. I mean, the US is a very growth focused market. Remember, I mean, it's quite a sort of oxymoron to call it, growth, because you buy it when there is no real economic growth, right? You pay up for the earnings of companies like Microsoft and Nvidia and so on and so forth when you can't get cheap revenue growth elsewhere in the world. When, if emerging markets are growing or mining and metals are chucking off, very rapid growth in revenues, you don't have to pay, 30 times, 40 times for these other companies, right? You can buy them cheaply. So what I'm describing here is a period where, certainly from a standard perspective, you would be looking for US growth to underperform US value, right?
So, and you don't, aside from the Brazilian bonds where you're really getting paid to hold them, you're very bearish bonds, no developed world bonds.
No, I just think, I think, for the moment, until governments intervene, which will probably come, Maggie, and then you really switch all your money into like precious metals and currency, when those trades start, right? I just don't think there's any reason to be long, certainly the long end of long to even 10 to 30 year sector of any of these markets. Maybe fives, right? Maybe fives, but I see no reason. I see absolutely no reason. They're, to my mind, they've been an instrument of confiscation. If you look at total returns of US treasuries, I was playing around with this chart the other day. It is, I think it's been in a downtrend against cash gold. So no dividend on the gold at all. So take treasuries, including the dividend. They've basically been losing value versus gold since 2003, right? It is just atrocious, Maggie, right? Atrocious. And you've lost a shed load of cash on that relative trade.
And when you think about the fact that a lot of people are still operating on a 60-40, hopefully some of them have it's been a much shorter duration.
It's the frog, right? It's the poor old frog.
Well, it's just hard to turn the conditioning everyone's been exposed to. Integral as well. Integral has a very interesting question. Would love to hear Julian's take on stable coins. Will they become the new petrodollar and payment currency for U.S. trading partners? Are stable coins actually bullish for the US dollar?
Not really. I don't. So I've been thinking about this a little bit. Look, I think this is the way we're going. We're going to some sort of digitalized currencies. All the central banks will probably issue in them some way, shape, or form. I think the biggest consequence, I think, of, let's say we have stable coins and my concern in the US is a couple of fold. So if we're not going to have a Fed stable coin, we're going to have a JP Morgan one and a Wells Fargo one. My concern is a couple of things. Firstly, my concern is they're going to pull money out of the smaller regional banks because they won't have such a credible coin of their own unless they somehow get together and amalgamate, right? Because you'd much rather have your money, because you're essentially taking credit risk if you have private sector stable coins, right? So I'd much rather have my money in the JP Morgan stable coin than in the Bank One of Colorado stable coin. Well, okay, fine, but that's bloody enormous consequences for Colorado, right? Because Bank One lended a lot of money there, right? So that's one. The second thing is I think they will attract money from emerging markets, some emerging market countries. And because you'd much rather, if you were in, somewhere which is, a less credible central bank, that you hold your money into that. So I think that's one thing. I'm not sure that net that on the margins creates some demand for dollars, but I think within the US and within the efficient global developed markets, I think the idea that we're going to create new demand for dollars and really what we're talking about is demand for short dated bills, right? Short dated bills to help funders, I think is a bit of an anathema because I think we're bloody efficient, Maggie, at utilizing that money. The money that's sitting in your deposit account isn't sitting in your deposit account in little bills, right? He's swept every single night into the treasury market, right? By JP Morgan or by Wells Fargo or whoever, or B of A, right? And that money is already utilized. So I think this idea that we're going to wake up one day and we're going to be like, you know, an unlimited demand for bills, I think is a bit BS.
Interesting. It's a question that's going to keep coming up though, because there's, you know, so much happening on this front, especially with the administration, you know, pushing behind it. So it's something that's certainly worth revisiting. Julian, it was so fabulous to catch up with you. So happy that you were the first guest under the new Market House.
Woo!
Some same, some different. But yeah, it was really fun to have you. And of course, we're going to always, as we do, put a link in where you can find Julian's MacroCapture, which can keep you up to date on everything in the link. So be sure to check that out. And thanks to everybody for the kind comments. We missed you guys too, but we were working hard behind the scenes. So, oh wait, what is this? Will the cost of entry and stable less than traditional costs? Yeah, we got a lot of comments coming in on stablecoins. We'll keep revisiting that, guys.
Look, I think it's fascinating. I think, you know, just, you know, sort of calm some of the ardor. I think there's people get very excited by this.
Yeah. Right? And it's all new, right? So there's a lot that needs to be worked out. So, and maybe bigger fish to fry first. Last question. Worried about the jobs report? You think that's gonna be a market mover on Friday? We didn't even talk about that.
I mean, look, my view is absent immigration, that the non-farm payroll headline rate has automatically declined. Right? If your break-even rate was 120, it's probably 50 now, right? Because immigration was a very large proportion under the Biden administration of the growth in non-farm payrolls. Now, I personally, my models are not showing any increase in the unemployment rate for the next few months. It's stuck at 4.2, 4.3. So that, to me, in an environment of low immigration, that should be the real decider. But of course, you know, the market's going to get its knickers in a twist if we get a 50,000 number. Look, I've got a mate who does this professionally and thinks we get a 80,000, 90,000 number. I think anyone who tries to do this professionally is like juggling the chainsaw, you know, because it all comes down to the revisions that the BLS decides to throw at it, Maggie, right? But he's got a very good track record, and so I'll sort of go with him.
Yeah, absolutely. There's a lot of work to be done on that front, figuring that all out. Yes. Julian, as I said, great stuff. Thanks so much. Thanks everybody for joining, and thanks for all the support. As always, take care and good luck out there.